Michael, let's begin with you. Stifel is the 7th largest full-service investment firm. Tell us a little bit about your clients, your investors, and are you seeing younger investors coming into the fold?
Sure. So Stifel, basically think of Stifel as a middle firm, meaning not as big as the largest, larger than boutiques. So we have kind of the classic set of clients, both institutional and wealth. I would say on the wealth side, a good amount of our sort of younger investor is really next generation. Could be second generation, third generation in a family that we're serving, but we're definitely seeing it.
Yeah, and we'll be talking about that wealth transfer in a moment. Yelena, I love speaking with economists. We put you on the spot. I have to ask you, is this, given all of the challenges going on right now, has this been one of the most challenging forecasting times for you as an economist?
Definitely, 100%. I mean, not just this year, last year, even early 2020, when this the COVID outbreak was first just centered in China, and we were assuming maybe we'll shave 1 percentage point off of U.S. growth. How silly were we to assume those things? So this has been a very humbling experience for forecasters, definitely.
Jean, Deepwater Asset Management, which has a new name as of just a few days ago, presents itself as a tech-focused investment firm. Explain what that means.
So we're investing in private and public companies. That's different than where we started, which was only private. And we're focused on growth that's enabled by tech. So all the companies that we invest in, we have a belief that they're going to have growth that's persistently higher than most investors expect.
Michael, you bring up a lot of investment themes that you're looking at right now, and you call it the fourth industrial revolution. That's a big concept. Explain what that means and some of the things that you are looking at.
Sure. Well, and just to be clear, that's a World Economic Forum concept. There's a lot of research going on there. Really, I think some of it gets discussed at Davos, for example. But we've sort of embraced it for the idea that technology and the advances in technology are really accelerating both the speed and scale of change. And when it comes to investing, of course, we go back and look back, you could say, hey, let's invest in those tech companies that are developing the technology. But as we look forward, the themes are evolving to digitalization. How can traditional businesses take advantage of these specific opportunities?
Jean, I have to ask you about this, and anyone feel free to jump in. We're bringing up technology, but it's been challenging times for technology lately. You boldly make a lot of predictions on your website. I think it's fantastic,
Appreciate
and you
that.
give yourself a report card, basically.
Thumbs up and thumbs down.
Yes, and it's bold, and it's actually great. So there are a couple of things that you are predicting. You are predicting that, first of all, there are going to be fewer unicorns this year, and that would imply that there are fewer investment opportunities when it comes to tech. Do you want to dive into that a little bit more?
Fewer opportunities, I think, in investing, or I think the opportunities are presenting themselves as these once unicorns decrease in value. And we're probably going to see a 50% haircut. I don't remember the numbers off the top of my head. It's something, there's like 700 unicorns. It probably goes down to 300, something like that. It's going to be a measurable drop. There's going to be opportunities there, ultimately, to own some of those good companies. That's part of the reason, too, why we want to be both private and public, because we think some of the best opportunities are in the public markets today.
Yeah, and you do both. You do a hybrid now as well in some of your funds. We have a great question for Yelena coming in. When you're researching, do you prefer more lagging or leading indicators? And which indicators do you most rely on?
Thank you. Yeah, thank you to the audience member. That's an excellent question. I think the first thing we need to think about is what are we trying to answer? Are we trying to figure out what's going to happen, or are we trying to figure out what has happened? So the lagging indicators are good to understand what has happened, especially as they come in more revised, especially thinking about the unemployment report, the BLS jobs numbers. But when it comes to leading indicators, those are my favorite. And I would say I'm very much interested in sentiment from home builders, sentiment from consumers, sentiment from business people, because that helps understand where decisions are going, what we're going to be thinking about when we think about hiring decisions, spending decisions, and then when it comes to the housing market, which is one of my focuses, what is the housing construction going to look like over the next year or two, because that tends to lead the overall economy. When you buy a house, you need to buy things to fill it with. Consumption is 70% of our economy, so those things really rely on each other.
What are they saying? What are the leading indicators saying?
I was just
on
going to ask
construction?
that. Tell us more about what you
Thank
see in the housing market.
So it's actually quite interesting. Just this month, we received the National Association of Home Builders, Single-Family Builders sentiment, and even though it's still considered in contractionary territory, anything below 50 is contractionary, it had a small tick up for the first time since August, so however many months that is. And so yes, housing is still inside that downturn, very cyclical indicator, very responsive to high interest rates. But on the upside, when we start seeing rates come down, mortgage rates come down, the demand is there. It's going to be one of the first sectors to come out of that negative area.
I'm excited for, I think there's going to be some money made and invest in some of these real estate tech companies too, because everybody, I don't like this word, the word is banned in our home, hate, but there's a lot of people that hate real estate stocks right now, and I think they're going to make a run, as you're talking about. We're owners, by the way, of Zillow, so fair disclosure.
Oh, okay. Thank you for that disclosure. Well, talking about housing, a lot of the issues are tied to, again, the generation. Some saying the housing stock is in part because of the older generation holding on to their homes. Maybe this is a good time to bring up that wealth transfer in the generations, Michael, because a lot of young investors are going to start investing whether they like it or not, because they are going to get one of the largest percentage wealth transfers ever, with the baby boomers now transferring to the millennials. And that, of course, must affect who is starting to invest with you.
Yeah, I mean, I think to me what's interesting about that transfer is when we take a step back and say, okay, it's going to feel dramatic over, I don't know, 10, 15 years. That seems intense. In practice, it happens gradually. Right? And so what's happening is we're serving clients in the way we traditionally would. A next generation individual comes into the mix. Maybe there's a trust set up for them or another account set up for them. And all of a sudden we're engaging more on their terms. When we were prepping for this, the question came up about asset allocation and sectors. And I said, that next generation really doesn't use that nomenclature. They're very much, in my view, bottom up. They're looking for themes that they can get behind, that they're interested in. I think given what we've been through with the great financial crisis and even the pandemic and the market's reaction, they're actually a little bit risk averse. And so a lot of what we do, it sounds sort of straightforward, is we're, on one hand, coaching them on diversification, kind of classic investing. And in today's world, of course, two examples where there's opportunity, as boring as it is, fixed income, non-US stocks, two things that have been out of favor. But we frame it and really look for opportunities that are more bottom up and relate to the themes they're invested in or interested in.
Great question. A lot of great questions from the audience. For public sector investments, we are living through a massive government push towards national clean energy development, the Inflation Reduction Act. How are you adding this into your evaluation? And maybe I will ask you first, because you do both public and private investments as well. And with that, sorry to make this an extra complex question.
Okay.
Are the younger investors demanding more as far as the social impact issues when they say they want to invest?
I don't know. On the second one, my sense is yes, but I don't know for sure. On the clean energy piece, there's still this challenge that we have around, does it work? I'll give you a quick example. If you look at a Tesla roof, very cool, typical Tesla roof costs a typical home to put a Tesla roof on. It's about $125,000. You get about 30% of that back from the government now. And your payback period, in theory, is about 15 to 20 years, something like that. The problem is if you take that 75 grand that you would have spent and put it in the market and earn 5%, your payback period is never. And so there is, I think, just still some underlying challenges. In the case of the electrification, I think there's good advantages there. I think that there's going to be investments around that. And so to answer your question, how are we doing it? We're hoping that Tesla blows up when they report tomorrow, and then we can make an investment decision at that time. We're not saying we're going to buy or sell or do anything, but you have to be valuation sensitive, is my point to that, around some of these big themes.
Gotcha. Okay, the theme of this conversation is going long, so let's put you on the spot again for some more predictions. Yelena, you're an economist. Everyone's asking right now, what are the chances that we are going to have a recession? And if so, what flavor of recession.
Right, yes, because recessions are not all alike. And as we focus this panel more towards the young investor, and panelists from the previous sessions have mentioned, most young people were born into a period of very low inflation, very long business cycles, and so recessions are actually very different from one another. So the one we're expecting in our forecast is a mild recession, a Fed-induced recession. That means they're hammering demand to bring it down to the level of supply in a supply-constrained world. So when the Fed brings us into a recession like that, it's easier for them to get us out of a recession on the other side of it once they've seen inflation come down closer to their 2% target. So the timing is quite tricky. We do have it in for this year, but timing that has been very tricky over the last few quarters because consumers and businesses have been so resilient, have really been pushing through all of those downward indicators and still hiring, still spending, but we are seeing credit card usage go up. We are seeing those high interest rates really impacting, for example, the housing market, and so that mild recession is expected this year, but we could be surprised.
All right, Michael, I think I'm going to bring you into this because audience members also want to know how you are investing, given what the Fed is doing and what you see there.
Yeah, I mean, just to frame maybe first our outlook, we see this year as really two phases. And markets felt pretty good the last couple of weeks or so. We think volatility will continue. Who knows exactly what the messaging will be at the end of the month from the Fed, but there's a chance of some volatility. Maybe we won't quite get the happy Fed that everybody's now anticipating. In any event, the way we think about it is we see essentially 2 quarter points from them, maybe a recession, maybe not, sort of zero growth. As it relates to investing then, we have talked a lot about the idea of making sure people, if they haven't been invested in fixed income, moving back into that is really a great opportunity relative to sort of recent periods. In any event, more broadly, with this volatility, near-term focus on quality. In any event, what we think is we'll see the Fed act. We're calling for 50 and then a pause. We think that will help people calm down a little bit. We're calling finding balance in our outlook. And from there, some positive results more in the second half of the year.
By the way, we always carry the Fed live. They're never supposed to be happy. Even when things are going well, they just never seem happy. They always seem to be guarded. Jean, let me ask you, we had some questions about your interest in emerging or small companies versus larger, private versus public. I want to put you on the spot with a prediction that you made on your website that a few months ago that the FANG would outperform the S&P 500. Of course, a lot has changed even in the last few days. Do you stick with that position?
Yeah, I think last year we saw a difference. Obviously, the FANG had a lot of good years. Last year was not a good year. I think the simple reality is that most of these companies were dependent on them. And I think that even when they're having these layoffs, and we're expecting a pretty subdued tone from Microsoft tonight and from Google next week, Apple's probably going to be probably Apple-like optimistic. But I think all in, if you look at the balance of this year, still feel optimistic about that prediction.
Okay. Yelena, I want to quickly ask you, of all of the factors that you weigh when you make your forecast, what is most worrisome to you right now? Is it the geopolitical instability? Is it the inflation? Is it the challenges on the labor markets?
Yeah, it's a complicated question because it's not just one thing. It's, obviously these supply shocks we've experienced over the last few years have been independent of each other, but they've all accumulated to the point where we're now seeing high inflation from both the demand side and the supply side of the economy, and more specifically the labor market. Labor market shortages have been exacerbated by COVID, but a lot of trends were already in place prior to COVID. We've had a big shortfall in immigration for many years. We had a lot of pulling forward of retirements, especially folks who were not quite in that retirement age. They decided to do that early retirement. And then we have the next generation, especially with Gen Z, it's a much smaller generation. And so these labor market shortages, these are the structural things in the economy that are not going to be solved with monetary policy that create a lot of complication for folks who are trying to think of, where is growth going from here? How are we going to stimulate growth without stimulating too much inflation, but also handling those structural problems that we have in the economy.
Do you think there's...
Oh, go on.
Do you think they're solved by... is this a political question around labor? Is it immigration related or...
I don't have a prescription for this, the silver bullet for it. So immigration is definitely a concern. I myself am an immigrant, so I'm obviously pro-immigration. I'm from Canada, and so we have the immigration question that's been a political hot potato for many years now. We have the concern about the aging demographics, and then we also in the United States for women's labor force participation on the prime age is about 12 percentage points lower than Canada's, and so that's a concern. What policies do we have in place that encourage women, especially women of color, and then people of color in general? There's a lot of wasted talent that's not being tapped into based on discrimination and bias in the workplace and in the investment environment that's keeping a lot of these folks from participating to their full potential.
Yeah, and of course, the Great Resignation was so much more pronounced with women. I had a conversation with the CEO of KPMG US last week, and we were discussing about how unusual it is now that you have an environment where there are massive layoffs within a lot of the companies that you follow, and yet those same companies are having a terrible time hiring. So they need to both cut and grow at the same time, and they need to do it strategically. There is a question that I think all three of you could answer. Our time is really flying by, but it has to do with international and emerging markets that had underperformed for so long. One of our audience members had asked if you think that there's going to be a rebound. I'd love a quick take from all three of you. So Michael, maybe you first.
Well, I think we're experiencing it, right? It's been a long haul where non-U.S. investments, especially stocks, have sort of lagged here in the U.S. We're seeing a rotation away from that, with especially a little bit with a weaker dollar. Our counsel to clients for sure is to be globally diversified. Our counsel for sure is that there's great investment opportunities offshore. And so we guide people to be allocated. And as I said about bonds earlier, if they're not there, it's a time to take a look and sort of build back out that allocation.
Jean, did you?
I don't have anything to add.
I would agree with that, and I think that when it comes to the international picture, we are going through a much more fragmented world on the other side of COVID. I'm not saying that there is deglobalization, but there's a lot more fragmentation. And so, for example, in Europe, we're seeing that energy crisis really impact them much more than we have here in the U.S. And so pay attention to how some of these trends impact other countries compared to the U.S., because we're not in the synchronized cycle as we were prior to the pandemic. And also, obviously, the supply shocks and the black swans that keep popping up. Again, I'm very humbled in my forecasting, so I won't make predictions there.
Elaine, a quick question. Do you see more layoffs coming? Will they continue to be severe, or do you think we're moderating?
We have a very, in our mild recession baseline scenario, we have a very low peak unemployment rate by the end of this year at about nearing 5.3%. That's quite low when you compare it to the peak unemployment of prior recessions. Again, this is the Fed creating that mild recession, really quashing demand from the labor side to bring both the job postings down and then also some of those cuts. But we don't have it sector specific, and we do see a recovery happening much quicker.
So, Jean, as an investor in the private public markets on very young companies as well as mature ones, I just want to ask you about some of the trends that you are also following. We talk about this fourth industrial revolution, the shift in demographics, and how that's affecting industry and how we invest. What are the things that you find most interesting now?
For sure, it's OpenAI. I got a question. I mean, just my nickname is when I was in fourth, fifth grade was the Riddler, so I still love asking questions. I guess the group of question here, who has tried ChatGPT? Okay, get the hands real high. Get the hands. Okay. Okay.
Wow.
Now, by the way, all they've said is there's 1 million users. They haven't updated the number. I think it's probably like hundreds of millions at this point. Second question is, who's done it for more than gone back a second time and tried it? Maybe a quarter or something like that.
Just for our virtual audience, I want to just say that the majority of people in this room
Majority
raised
of the
their
people
hand,
said,
and about a quarter of the room, and we have an oversubscribed room because we had to bring in extra chairs, said they tried it again.
Yeah, so my point is that at this point it's still a little bit of a carnival trick. It just kind of catches your attention, but ultimately they're going to get it better. They will get it better. Who's really going to get it better is Google's going to likely make some big improvements there. They've hinted that they're going to have something out before the summer. That would include some more real-time information. So to answer your question, what's really exciting? I think what's going around with artificial intelligence and the chat bots are representative of we're getting closer to general intelligence. Just to finish the story, when we get to general intelligence, then things get kind of goofy. I mean, we could get to super intelligence. At that point, it could be the curve, in theory, goes like that, where machines are smarter than humans. So kind of scary, exciting, and there's ways to play that in the private space on companies that are making AI, and there's ways to play it public, whether it's Microsoft or Google.
Let me follow up with that because I don't know this space that well. Are U.S. companies leading this innovation, or are we behind? Or are we
It's
equal?
generally considered China, U.S.
Yeah.
My guess is China's ahead just because they're so smart. So I'd probably guess
And we
that
don't
China's
know.
ahead. Hard to say, but my guess is that they've had more resources poured. They get public resources poured, government resources poured into AI, where in the U.S. it's predominantly private.
Do you think that we need more government support? In this
Absolutely.
space?
I mean, this is the new forefront. I mean, it's everything from, I mean, if you get to superintelligence, the way the machine can help build our cities, to help with our healthcare, there's a lot of benefits to it. Again, I'm 52, I'm an old man. I probably won't see superintelligence, but we have to start preparing for it.
Michael, care to weigh in on that?
Yeah, I mean, a couple of things. First, I think to your point, it's really, really early innings. What's so striking about it is you can see the power by trying it out. I was thinking about trying to get this thing to write my weekly note and see what it looks like. You know, you really can do things like that. I haven't done it yet.
Okay.
You're inspiring me. But to your point, it's really, really early innings. Like the big players aren't yet out to market with capabilities in a way. And so where do we go from here? I think as it relates to how we relate this back to investing, you know, in my mind, a lot of what we're navigating is with these capabilities coming out, how do businesses embrace and take advantage of them? And it's really businesses across the spectrum. And you know, so I'm an optimist by my nature. I think there's going to be huge opportunity looking forward.
Mm-hmm. We always get this question when we discuss the future investor, and it's the same question that came up with some of the earlier conversations. We have to ask you about crypto because some people in the audience are asking about the prediction for Bitcoin specifically and crypto in general. So, Michael, is this an asset class that you have fully embraced as Stifel? Are you still looking at it and it's limited?
Yeah, so as I'd say, as it relates to digital currencies generally, you know, and my team's one of those responsible for what I'll call the assessment of risk. So when we look at the pattern of investment experience related to digital currencies, it's pretty darn volatile. So the idea of taking something like that and fitting it into an asset allocation, it's pretty hard to do. We know clients are doing it. We'll hear from them how they're engaging. Our guidance, therefore, is usually about percentage of wealth and kind of managing it because the risk side model is pretty heavy. I will say, of course, is sort of the logical thing, when we look behind it, when we look at blockchain and the capabilities related to things like that, that's a whole other thing. Once again, we're looking at how companies are exploring taking advantage of that kind of technology. And you know, let's just say, I think it's scores of business opportunities related to blockchain that have nothing to do with digital currency.
Yelena, I want to ask you that, of course, we think of digitization of everything, of industry, of businesses, of becoming more efficient, making us better. But it's really hard when it comes to crypto because it's hard to measure something that hasn't always provided accurate information for someone like an economist to follow. I just would like your thoughts on this as well.
Honestly, we don't do a lot of analysis on crypto. This is something that I personally believe is, like Michael had said, it's a volatile asset class. And so I don't really have much to contribute, I'm sorry. But this is, I agree that the blockchain technology, all these kinds of technologies underneath there are definitely here to stay.
Jean, is this an asset class that you're investing in at Deepwater?
We were. A year ago, we stopped early in 2022.
Well, aren't you
Yeah.
smart?
Well, it was, I would say this, I think it was a wash from where we were investing at that point. We haven't gone back.
So we are actually down to our last 4 minutes. So if you have questions, quickly submit them. I always like to end conversations, especially with people in your positions, to look forward. I mean, we had a difficult 2022. And as I opened this event, 23 looks to be challenging as well. So I want to ask you about the things that most concern you and intrigue you in the next 6 to 8 months. So Jean, let's go ahead and start with you.
If I was going to boil it down to one company, I think it's Tesla. I think it's, I mentioned, that this pullback, we're hoping for that. We're not invested at this point, but I think that there's a valuation, near-term valuation question. But I think long-term, this company is really going places. I talked about the return on the renewables. I think they'll get that squared away. And I think they're going to, this price decrease, I think they are absolutely going to crush the competition. Mm-hmm. They're going to be gaining significant market share. It's a pretty emotional story around it, but I'm a big believer long-term in where they're going. And maybe they even get this robot to work. If anybody's going to pull it off, it's going to be Elon. So don't want to put a price target on it.
Even with the distractions going on currently.
He's the master of navigation. Okay. And so I think that's still going to be the gift that keeps giving in terms of entertainment of personalities and companies.
Very quick question. I just would be remiss if I didn't ask it. The question just disappeared, but it was asking about, do you find public investments more intriguing versus private? Because some people think that private markets are more efficient right now, greater returns.
I think there's been more disruption in the public markets that creates opportunities more near term. Long term, the private's more exciting just because it's more cutting edge.
Okay. And Yelena, your biggest concerns as you look to forecast in the next 6 to 8 months?
Yeah, I wouldn't say it's as much of a concern as something we're definitely keeping an eye on, which is when the Fed starts to cut rates. As we've seen in our models and as we've seen coming out of this pandemic, we essentially went through a wormhole where the world on the other side is very different than the world we left behind, where now a small Fed cut is going to have a really big impact on the US economy in terms of spurring demand again. So this cut and versus hike scenario is very nonlinear. And so I see the question about the Fed's soft landing. And so the window to the path to soft landing is narrowing, to use Powell's words. I mean, it's still a possibility. And if you consider only a 5.3 unemployment rate a soft landing, then there's your answer. But really, we're paying attention to, the Fed has made it clear they're going to hold rates at that higher point. We expect 3 quarter-point hikes over the next 3 meetings. And then for them to stay there essentially into the end of the year. But what's that going to look like when they even start to hint at rate cuts? What kind of demand is that going to spur? What kind of rally is that going to spur? And as I mentioned, the housing market on the other side of that will be one of the first to recover.
Can you be more specific to this question about the probability of Fed soft landing? Do you want to share your prediction?
Can I pull a Larry Summers and say 33%, 33%, 33%, and just even it out?
Larry is usually more blunt than that. I know from experience being in Boston, but yes, that's absolutely fine. Michael, the final minute belongs to you. As far as looking ahead to 6 to 8 months, if you have an investor in your office, what are some of the things that you discuss with them as far as opportunities we should be seeing and biggest concerns?
Yeah, concerns really relate to balance. When we started 22, our theme was finding balance. We had imbalances through the year, which drove inflation up and the Fed higher in terms of rates. And now we're trying to find balance. So I think to Yelena's point, that to me, the spirit of it is the Fed's got to sort of navigate this, take some further action, but not go too far. And it's going to be, in my view, the risk is, how's the market reacting to all that? And do they go too far? As I alluded to earlier, though, as it relates to opportunities looking forward, I said this in another meeting a week ago, it's a great time to be investing. Fixed income is super attractive, non-US is super attractive. When we look bottom up, valuation-wise, lots of great opportunities. So when we look out to the second half of the year, we're pretty optimistic.
All right, Michael, Yelena, Jean, thank you for a fascinating conversation.